Hi, it's Brian Decker with your Market Minute. Hope you're having a great week. 2 weeks ago, we talked about how we get the risk managers. Last week, we talked about our tactical manager. Today, I want to talk about our Nasdaq ETF manager. He's been around the longest. He goes back to 2000 even, so he's been with us. He's been a manager for 21 years. He has a long-short strategy in his computer trend following models. And in 2000, 01, and 02, when the Nasdaq lost 70%, 100,000 in the Nasdaq dropped to 29,000 and change, his 100,000 went to 300,000. He did very well in 2000, 01, and 02, made money in all the years from 03 to actually up to 2016 was his first negative year. But in 2008, with the Nasdaq down 40%, he was up 23. These are net of fee numbers. And he's averaged, in 21 years, he's averaged 24.6%. Average annual return from the Nasdaq in that same period is 10%. 100,000 invested in the Nasdaq since January 1 of 2000. At the end of last year is worth 365,000. 100,000 with this manager is worth almost $7 million. The key is not taking that 70% hit in 2000, 01, and 02, and not taking the hit in 2008 of 40%. There's three ways, like we talked about, to protect money in the downside. One is to go to cash, which our Nasdaq mutual fund manager does. We'll talk about him next week. The second is, like tactical does, buy whatever is trending higher, which is pure momentum, which is relative strength investing. And the third way is this manager, where when the trend of the market goes down, he's able to buy inverse ETFs and make money as the markets drop. So he's able to do well. He's the only one of our 5 managers this year that is making money. He's up double digits, and the other 4 of the 5 managers are experiencing model risk. Model risk is the one negative that's attached to computer trend following models. If you use computer models, the good news is you have a two-sided strategy in a two-sided market. The good news is you have 2.5 times the returns typically of the benchmark. The one negative is model risk, and we're experiencing that this year with 4 of our 5 managers underperforming and flat for the year. Gold and silver are down, tactical managers flat, and our manager that was up 98% last year, the Nasdaq mutual fund manager, is flat for the year too. It's just this manager that's positive. But he had model risk. If you pull up the fact sheets, he had model risk years. He was up 1 in 2012 when the Nasdaq was up 17. And he lost money in 2016 and 2018. Those years weren't a problem for any of our other managers. That's why they're non-correlated, meaning that when one manager has a bad year, typically the others don't. So that's why this year is such a statistical anomaly. Hope you have a great rest of your week. This is Brian Decker with your Market Minute.